S&P's down about 1.5%. That's a loss of 60. NASDAQ 1.5 to the downside, 173 decline, 357 is where we are in the 10-year. Services, ISM beat, factory orders beat. Market may not like that because obviously the implications that has for the Fed. But Steph, let's just go this bull bear route. Tom Lee, okay, he still sees a rally into year end towards 44 to 4,500. Mike Wilson says it's time to fade it. Time to fade it. Take profits. What side are you on?
I'm kind of right down the middle.
No, that doesn't work.
I am.
Doesn't work.
All right. I'm right down the middle, medium term. I think we're going to be in a trading range for a while because we just have so many unknowns. And we get these weeks where we get good economic data, like today we got a great services number and factory orders. Last week was horrible data, right? So we are in this push-pull in the economy right now. We do not know what the Fed is really going to do, but they are restrictive. We know that. We don't know what the implications are because we've talked about the lag impact. That being said, I have said since the summer, I think you could have a rally into the end of the year, a relief rally.
Do you still believe that?
Yeah, I do. Yeah,
you do.
I do, because seasonally, but also positioning. Everybody is negative. Everybody is defensive. And so I'm taking opportunities where I can in terms of buying on weakness, selling where I have less conviction names. We'll talk about some of those in a little bit. But I do think we can rally here into the end of the year. Again, medium term, though, I worry because we just have so many unknowns. Now, all that being said, we've been talking the last couple of weeks. Actually, I'm starting to feel a little bit better about earnings because the dollar is weak. The dollar has pulled back, and that hurt earnings for multinationals 5 to 8% last quarter alone. So the dollar weakness is a good thing, I think. Right?
You know what it is? Dollar index lowest level, I think, since June.
Right. Input costs are coming down. Supply chains are actually freeing up a little bit. So, yeah, demand is going to be the question mark, but maybe companies can offset the weak demand with a little bit other help, a few more tailwinds that we haven't had in a very long time.
Now, I could easily go to Jim Lebenthal here, who would suggest that he thinks that we could have a year-end rally, too. However, I'm going to go to Joe first. I want to know.
Nice tease.
Well, because I think I know what side of the boat you're on, and I'm not exactly sure today what side Joe's on. 4,400 would be a 9% upside from here. 45 is 11.5. That's Tom Lee, okay? Is it time to buy into the rally? Mm-hmm. I mean, I don't know if you want to even call it a rally at this point, or fade it. Simple question. Two different strategies.
Okay, last week, I expected us to get a Federal Reserve-driven rally into the end of the week. We got that. Now can the market go another 10% through the remainder of the year towards 4,500? Let's say it can. I still don't want to take that trade. And
Do you think it can or not?
The
bottom line is, like, if you – all right, everybody wants to answer to the same question. Everybody wants to answer the same question. Joe, do you think we're going to have a rally into the end of the year, or are those hopes dashed?
December 13th, 8:30 in the morning. It's all dependent upon December 13th.
CPI?
At 8:30 in the morning, what is CPI? Last time CPI came out in November, what did the market rally? 7% off of that? Okay, so the market on a benign number could easily read. But I want to finish my thought for a second. Please. What happens after 44? Let's say on December 31st, we're at 4,500. What happens thereafter? You have to ask yourself that question. Is the overwhelming amount of challenging headwinds that have hamstrung the market for the entirety of 2022 on December 31st, do you have clarity resolved? No, you don't. So I think that you have to be cautious. I think to Steph's point, you have to maintain.
Well, Steph said their earnings may be better than people think.
They could
to your point of what happens after.
But I still want defensive positioning. And I'll tell you one other thing from an asset allocation perspective, and I'm hearing this in a lot of conversations that I'm having. On January 1st, when you measure equities relative to fixed income and now the emerging markets with China reopening, there's a lot of renewed interest in fixed income in a rebalancing opportunity and the emerging markets.
So if you look at the data that Steph points to today, obviously it's not pointing to a recession, okay? The jobs data is not pointing to a recession either. Wages are up. The Journal today puts out the idea that the Fed is penciling in their words, higher rates for next year because in part of wage growth. And maybe that's in part what the market doesn't like today is more economic data that's strong means that they need to stay more engaged. That in and of itself puts a cap on the market and the economy for that matter.
depending, Scott, on what actually happens with inflation. I'm looking at my screen right now. I'm looking at gasoline futures. They're at $2.24 a gallon, which is below the level on December 31st of last year. So all of Ukraine, all of that impact on fuel, take it out.
No, the Fed doesn't care about that, though.
Absolutely.
No, not as much. They care more about wages, right? You know that.
What they care about, we've had this argument before, is CPI. CPI. We're going to agree on that. They care on CPI. What goes into CPI includes wages. It also includes rents. It also includes goods prices. It also includes fuel prices. So what I'm saying is relevant. What you're saying is relevant, too. What I'm trying to dictate here, what I'm trying to put forth is the idea of a soft landing, the odds of that are increasing. But that means that I believe so, because what is a soft landing? It's full employment, which we've clearly got. It's a strong economy, which we've clearly got. And it's decreasing inflation. Now, this is a hypothesis that is partially proven out by the October inflation number, but Joe makes a good point. You have to see November's inflation number. We have PPI this Friday. You have to get those inflation numbers to determine, was October a blip, or was it the start of a real trend of inflation coming down more rapidly than the market or even the Fed thinks? I went to the fuel, and I'm not disagreeing with what you're saying about
headline, right? They don't,
It matters. It matters to my call. It matters to my call that inflation is coming down more rapidly than expected.
PCE is what the Fed really looks at.
So let's look at rents.
Let's look at 5% year-over-year growth, and they want it to be 2%. It's nowhere near
heading
where they
in the
need
right
to
direction.
be.
It doesn't matter. It's not going to be. There's no way that the November core CPI is going to be anywhere near 2%. I don't think that's really what you're saying. I think both of us will agree that what you want to see is what expectations are going in, okay? And I believe it's 6.2% for core CPI. Don't quote me, but I believe
it's at 7.3.
Yeah. If you get numbers that are better than those, Steph, I think you'll agree with me the market's going to rally. And that's the call. That's the call I'm making. But I'm just saying on
inflation, you've got to be careful, though, because they do look at a lot of various different metrics. And core PCE is one that he even talked about, Powell did last Wednesday. That's what he's looking at because of the wage importance within core PCE.
They all matter. They all matter. He has, by the way, core PCE is traditionally what the Fed's looked at. This year, he has shifted to CPI. But nonetheless, the point is this. What is the trend? Are the numbers coming in better than expected? That's why, to Joe's point, the CPI, and I'll tell you the PPI this Friday also matters.
Yeah. Mr. Brook, go ahead. Weigh in.
I agree that CPI, PPI, they're front and center here, Friday and then Tuesday. But where are the risks skewed? Right now, we're 4,100, big trend line from the record highs. The risks are to the downside. And if this number is in line, we're not going to rally. Like, if the market was at 3,700, CPI is in line, we could rally from that. The risks right now are to the downside. So am I cautious here? Yes. Is 4,400 doable? Yes. But I think we need to consolidate, digest what we've seen here in the last couple of weeks and settle in and bring this market down to a level where it can rally after the Fed takes forth from the CPI number.
So, Stephanie Link, you made a move in the market that doesn't scream of somebody who's that cautious. Okay? You bought Cleveland Cliffs.
Not that cautious, especially into the end of the year. I just said I think that there's going to be a rally.
You bought this for the 3 weeks?
I bought, the way this thing trades, it certainly could be doubtful because I am a long-term investor. Maybe I'll take some off if it rallies. We'll see. But I like the story. The stock is down 25% year to date. It trades at 5 times earnings, 3 times EBITDA, and I like what they're doing in terms of their balance sheet. I think the demand equation gets improved because of the infrastructure bill. Auto also is recovering nicely, and so I just think the risk-reward is really pretty good here.
But this is a soft landing purchase.
Yeah, could be. I'm not saying...
You don't buy Cleveland Cliffs if you think we're going into a recession.
I'm not saying we're going into a recession. I'm saying, we just don't know. And we know we're going to slow down, but look, we just got a much better GDP number for 3Q. The Atlanta Fed GDP now is looking for 3% growth, even if we go to 2% or 1.5%. This stock is so cheap at this point, and I like what they're doing internally, and especially because I think they have pricing power.
Unless it's cheap for a reason. I just go back to the fact that it's hard to buy cyclical stocks like this exposed to the global economy if you...
Right. And you also push back when I bought Caterpillar. And Caterpillar's higher from when I bought it, too. So I do lean more cyclical. I have been overweight energy. I have been overweight industrials, materials all year long, financials as well. And that's been quite frustrating as of late. But I'm trying to be balanced in what I see in the economy. I think it's going to slow. But I also see that these sectors that I'm overweight in are under-owned, underappreciated, quite cheap, generating huge free cash flow. So there's the
Now, again, I
opportunity.
could easily go to Jim for the Cleveland Cliffs thing, but I'll go to Joe first.
I appreciate that.
Go ahead.
The trigger for your trade to work is the dollar. It's not so much that you need to see the economy make this dramatic battleship turn. You just need some relief for the U.S. dollar. And I think a lot of the material story, whether it's Freeport-McMoRan, Corteva, where I know you are, Nucor, Albemarle, FMC, a lot of that material story is going to begin to work. And you're getting the glimpse that maybe the peak dollar story is in play.
Well, what if China comes back as well?
Well,
Add
China
that,
is.
right?
I think that's being priced into the market right now. I think we understand that China is
Slowly.
moving towards a full reopening.
Yeah, I would agree, but that's only going to be more tailwinds for these kinds of stocks.
We'll get to the China story, which is obviously significant, and good points that you make. Cleveland Cliffs. Jim owns it, obviously. I know he's a huge supporter of it, so I know what he's going to say. What about you? How do you grade it? How would you grade that?
I like the stock. I like the dollar, the fact that it's down. I'm a little worried now that the dollar is at support. So in the intermediate term, that could be a little bit of a headwind. But you pointed out Atlanta Fed GDP, 4.3% right now for quarter four. I see a soft landing. I don't see, people are talking about consumer credit.
You see a soft landing too?
Yeah, I see a soft landing. I don't think this thing is going to roll over. I don't think the economy is going to roll over. I think we're going to kind of smooth through the first quarter and second quarter of next year. I like Cleveland Cliffs. I don't own it right now.